Ladies and gentlemen, if I may have your attention, we've had a little trouble with the PA system here, and I think we have it resolved. I can hear my voice coming back at me, so I think I solved the problem. I haven't solved the problem. He did up there. We have a scheduled speaker. He's here. He's raring to go, but I'm going to, just for a few minutes, call on Barry Turner of the Canadian Former Members Association for a few remarks.
Thank you, President John, special guests, and as we say in Canada, mes chers amis. I bring you greetings from the Great White North, as usual. And I must admit, I always feel like I'm a member of your parliamentary family, and I truly love your city, Larry. It's a wonderful capital. And speaking of family, I'm very proud to have with me my gorgeous, talented, lovely sister, Kathy. Stand up, Kathy. This is my sister's first visit to your wonderful capital. Again, speaking of capital, Lou Fry, are you here? Remember a couple of years ago we had a bet, the Washington Capitals and the Ottawa Senators? We don't have to do that this year. Both teams are out of the money. And it never ceases to amaze me how many similarities we have between our two countries. Your new commander-in-chief was in Quebec City just about 10 or 12 days ago for the Summit of the Americas. Your Vice President Cheney was in Toronto, Ontario, 2 days ago. Last week we had a Canadian pilot from Calgary rescue an American doctor who was very ill, you may recall, in Antarctica. It was a perilous, treacherous, first ever rescue attempt of someone, and it was an American doctor. We had last week astronaut Chris Hadfield, who, as you may recall, launched the new Canadarm, what the space shuttle took up to the Soviet and American and Canadian astronauts who were working on the space station. And some of you also know that between our two countries, we have about $1 billion of two-way trade every day. So needless to say, our countries are close, from your new commander-in-chief to the work we're doing with you in space. Last fall, both countries had elections. Ours ended a little sooner than yours. However, the outcome was well received by the people. This is probably my last visit with you as chairman of the Canadian Association of Former Parliamentarians. I'm in my 6th year. And I've served with your presidents, Symington, President Boggs, President Fry, President McHugh, and now President Erlenborn. In fact, in Ottawa, they're now calling me Saddam Turner. But last year, I recall during your annual meeting, retiring Reverend Jim Ford inspired us with his words about public service. And this morning, those words were greatly reinforced by Jack Kemp, who I should also add used to quarterback the British Columbia Lions on the west coast of Canada. And I also say to you as a Canadian and as someone who served in our parliament, we're all in this together, and we must continue to believe that there's nothing wrong with honorable public service. Now, I have a surprise gift to give to two people here, if I may be so bold, Mr. President. One is to Linda Reid, and I would like Linda to come up here, please, because over my years of visiting you and becoming part of your family, Linda has always been very, very helpful. She's always opened me with open arms. And Linda, I bring you a gift from Canada.
That's not our running name down for C-SPAN.
Thank
you so much.
And President John, I have a gift for you, because this may be my last visit. I say maybe. If there's a coup, I will be out of office in June. If there's no coup, it'll be next year. John?
Thank you.
Thank you. And lastly, I extend this invitation to you always. James Symington and his lovely wife Sylvia came to visit with us in Ottawa 3 years ago at our annual general meeting. I am now extending a verbal invitation to all of you Certainly, I think Jack has expressed some interest in coming up to share his birthday on the 4th of June with us in our nation's capital in Ottawa. But the invitation, Mr. President, is to you and some members of your executive to join us on June 4th and 5th in our nation's capital, and I look forward to sharing some hospitality with all of you. So thank you very much.
Well, thank you very much, Barry. I have one other member or speaker to introduce to you, and that's Richard Balfe. Richard is a senior member of the European Parliament who is here. He told me because they're thinking of setting up, or they are in the process of setting up, a new former members association for the European Union, that he came here to find out some of the things that might be done. I'll let him put it in his own words. Richard?
Well, thank you, John. I won't detain you for long. What I actually said to John is the reason I'm here is to find out which mistakes you've made so that we don't copy them. I haven't found any yet. I think Linda does a marvellous job here, and our process here has been very smooth. I'd like to be able to introduce my lovely lady wife who's here with me. Unfortunately, she's in a shopping mall, but she will be available for inspection this evening, I hope without too many bills attached. This would definitely be my last visit, because I shouldn't even really be here as a serving member. But our Parliament was only directly elected for the first time in 1979. And after the last election, a demand came up for a former members' association, and I, in my capacity as the chairman of the House Administration Committee, which deals with members' pensions and the like, and is therefore in touch with them, was asked to get it off the ground. And it is now more or less there. We discovered we'd got over 1,000 ex-members, and when we eventually assembled their addresses and wrote to them, almost 600 of them replied and said they were interested. And it's a complicated procedure, as it probably was when yours was set up, because we have to get a statute through the Parliament, we have to get it registered by the Belgian lawyers, then we have to get members. But come November the 30th, the association will be launched, and one of the things we want to do is to liaise with both yourselves and the Canadian Association, because there is a lot in common. As Jack Kemp said to me this morning, divided by a common language. Well, we're divided by 11 common languages, but the European Parliament has 11 languages. But the reality is that English is the predominant language in the Parliament, and virtually all of the unofficial meetings are held in English, sometimes with a smattering of French. Indeed, we have a joke with the Canadians that more Canadian members of Parliament know French than European members of Parliament. We're very monolingual. You tend to know English in your own language. Let me also say how much, if any of you are coming to Europe, we'll be very happy to see you, show you around our Parliament. It's a very new Parliament. It's odd for someone to come from Europe and admire your history, isn't it? But I mean, nothing in our Parliament predates about 1985. It's a completely new building, a sort of state of the art, but no state of history in it. But you'll be very welcome to come round and have a look at it. I suggest that anyone who's thinking of coming comes to me, I'll give you a card. But even if you forget, Linda knows how to get hold of us, and I'm sure she will. We also have a number of elections coming up. Britain, France, Germany, 3 of the bigger countries in the near future. But then we have elections coming up all the time. We somehow have to get through them. But we're elected for 5-year fixed terms. So when there's an election, the members of the European Parliament don't change. That just happens every 5 years. I'm very pleased to be here. I've learned a lot. I'm still going to learn some more, because I'm going to stay around for this afternoon, including the business meeting where I'm told volunteers are needed. But I shall be there, and I'll be there at the dinner tonight. It's been a great privilege and pleasure to be here and to share experiences with you. I thank you all very much and look forward to us continuing to work together. Thank you.
And now for our featured speaker, James Glassman, who I discovered today is also known as Jim. Jim Glassman is an analyst and journalist. He's a resident fellow at the American Enterprise Institute, also the host of a website, techcentralstation.com. which provides news and opinion matters on public policy, technology, and finance. He writes a weekly financial column for the International Herald Tribune, the New York Daily News, and is a senior consultant and chief columnist for Folio.com, a financial services firm. There's a lot of other interesting things here, but because we had a delay in getting started, I'm just going to say, here he is, Jim Glassman, and I know you will enjoy what he has to tell us.
Thank you, Congressman Ellenborn. Please forgive me. This time of year, my voice gets kind of raspy, but I think it's strong enough so you can hear it. Thank you all. Thank you, Congressman Buechner, Jack, for inviting me. This is a great, great pleasure. I'm sorry I missed Jack Kemp this morning. I always love to hear Jack speak, and I know he gave a very powerful and touching address to you. It's so great to be at a place where I see so many of my old friends from back from my roll call days, as well as from my post-roll call days, when actually I've spent more time up here since I left roll call, where all I did was sit at my desk and edit all the time, which was not that much fun. You know, I think I've heard recently that there are those who claim that the quality of members of Congress has declined in recent years. Now, I don't know if that's true. If it is true, of course, then that means that the quality of former members of Congress has increased in recent years, so that's probably good. But it kind of rings true to me because of this story. You know, I was on a flight recently, and I spent a lot of time on airplanes, and so crazy things happen on planes these days. So we're flying cross country, and they put on a movie, Air Force One. And I thought, this is not an appropriate movie for an airplane, you know. But anyway, so I watched the movie, and I'm getting off the plane, and the fellow who was sitting next to me said, you know, that was a great movie. And I said, look, I've seen this movie so many times. He said, no, I'm telling you, it's a good movie. And not only that, they're making a sequel. And in the sequel, the terrorists do not kidnap the president. The terrorists kidnap the entire United States Congress, all 535 members. And they threaten that if their demands are not met, they will start to release members of Congress one by one. So this would really be terrible. And this is, I think, a reflection of the current state of Congress. Not when you were there. As I said, many of you may remember me as the editor of Roll Call or as a columnist for the Washington Post. And the truth is, I do a number of things, and lately I've been speaking on a number of topics: economics, finance, politics, technology. But when I get in front of an audience of former members of Congress or members of Congress and spouses, I know just what I ought to talk about first. I know what's really on their minds, what they are really interested in: stock tips. Right? Am I right about that? So actually, what I do want to talk about, since I spent so much time in recent years writing about the stock market, and since I'm the co-author of a book called Dow 36,000, and as a result have come in for quite a bit of fun lately, or criticism, I think it's actually great to be forced to defend your ideas, and that's what I've been doing for the last year, as the stock market has not performed quite to my satisfaction, although frankly not much, doesn't really change much of what we said, or anything really of what we said in Dow 36,000, which I'm going to get to. It's a book that I wrote with the economist Kevin Hassett, who is my colleague at the American Enterprise Institute, and we wrote, the book was published in September of 1999, and it argues very simply that stocks are undervalued, that using what we consider to be reasonable analysis, that the market should be about 3 times as high as it is today, or about 36,000. Now, when will it actually get there? I think pretty soon, maybe within 5 years, certainly within 10 years. And when that happens, stocks will be fully valued and returns will level off. Returns will be, instead of the historic 11% returns that we've gotten on average since 1926, returns on an annual basis will probably be more like 5 or 6%. So, if Kevin and I are right, we will have some very good years ahead of us. Doesn't mean we won't have corrections or bear markets, as we say in the book. The market is very volatile in the short term, but in general, we've got some good years ahead of us, and then things will level off. But within 20 or 25 years, we ought to get to about 80,000 on the Dow, or nearly 8 times the current level, in about 20 or 25 years. But actually, you could forget about Dow 36,000. You could say, well, I don't believe any of that nonsense that these guys are feeding us. And instead, look at the performance of the stock market historically since 1926. As I said, returns have been about 11% a year. And when you translate that into Dow terms and take out the dividends, what you find is, in fact, after about 20 or 25 years, the Dow, if it moves up at the rate that it has historically over the last 75 years, will reach about 80,000 within 20 or 25 years. So either you can buy into the Dow 36,000 message, or you don't have to. You end up in the same place. Stocks are a very, very good place to be. But I would say that even for people who can't wait 20 or 25 years, and people in their 30s and 40s, early 50s, who are planning to retire at a reasonable age, 20 years is not all that long a time. But people who don't have that long to wait, we think, in fact, that stocks are a great place to be even over 5-year periods, even over the next 5 years. Why do I say that? Well, very simply because in the short term, stocks are very, very volatile. I don't have to tell you that. You see Procter & Gamble drop 25% in a single day. We see enormous volatility in the stock market, and by the way, we always have. But the interesting thing about stock market volatility is that it levels off the longer you're in the market. In other words, by the day, by the week, by the month, even by the year, stocks are very volatile, very extremes of ups and downs. They produce extremes of ups and downs. For example, if we define the market as the Standard & Poor's 500 stock index, which is sort of the benchmark, if you look at the last 75 years, stocks have declined in 21 of those 75 years. In other words, 1 out of every 4 years, you're going to see, most likely, a decline in the stock market. Now, we've done much better than that in recent years. We've only had 1 decline last year in the last 10. But 1 out of 4 or 1 out of 3.5 is about the average. But when you hold stocks for longer periods, let's say 5 years, the number of periods in which there's been a decline really drops off. So there have been 75 periods since 1926 of 5 years. In those 71 periods, the market has increased 64 times. It's only fallen 7 times. In other words, 1 out of every 10 5-year periods. And when we go out 10 years, we find that stocks have declined only twice historically in any 10-year period. And in fact, when you factor in inflation, we find that the market has never, ever, since the 19th century, had a decline after inflation in a period of 17 years or longer. Now, of course, there are no guarantees in anything, certainly not in the stock market, but we do have a wealth of historical information to draw from. Still, it's very difficult in times like this to remember that. There's a famous quotation from Ecclesiasticus. In the day of prosperity, there is a forgetfulness of affliction, and in the day of affliction, there is no more remembrance of prosperity. And I think a lot of people may feel that way, at least as far as the stock market is concerned. But it is in times like this when it is most important, in fact, to hold on and, in fact, to buy. I believe that we are going through a very typical bear market period. We've had 11 bear markets since World War II, and they all have been quite similar. They take about a year or a year and a half to go down, and about a year or a year and a half to go up. On average, however, a year after hitting bottom, the market rises by almost half, about 46%. You get a tremendous bounce off the bottom. If we look only at the Dow, which I think is a good indication of the market as a whole, the Dow hit its low at 9,400. As of yesterday, it was at 10,900. So it's up 15% off its low, and it's up about 2% so far this year. The rise in the NASDAQ, as you know, was very spectacular. Then it took a big fall, and now it has bounced off that low. It's up from its low 32%. Now, I am not telling you that I know for a fact that we are out of the woods in this cycle. All I can tell you for certain is that markets always decline when the economy slows or enters a recession, and they always bounce back to a higher level when the economy begins to recover, and usually before it actually has recovered. And I can also say that bargains right now abound. You can find my own stock tips, if you want to call them that, in a portfolio that I composed just a few weeks ago for the website foliofn.com, which is where I now write a weekly column, which is also published in the New York Daily News and a few other newspapers. But among the companies that I have in this very unspectacular, very kind of boring portfolio are General Electric, Microsoft, Cisco, AOL, Time Warner, Automatic Data Processing. But I can also tell you that as investors, the most important part of being successful is allocating your assets, building diversified portfolios, and holding for the long term. A recent study by Chicago's Spectrum Group found that security selection, that is the actual stocks that you buy, accounts for only 5% of total performance. Of course, that's the fun part, the actual picking of the stocks. So I have a very comfortable, I would say, view of the market ahead. I would almost call it optimistic, but optimistic implies hope, and I hope that my judgments are based on more than hope. Now, Dow 36,000 itself was based on two big assumptions. The first was about the behavior of investors, and as you know, we have more and more investors in this country. There has been the advent of something that people have called the investor class. About half of all Americans now own stock. 40% are in 401k plans. And while there's been a lot of publicity about people being day traders, that is to say jumping in and out of the market, doing a lot of trading, at the very same time, we have seen people become more and more long-term investors, partly because of institutional changes like the 401k plan, where they don't have much choice. They've got to hold the money in until they're 59 and a half. They can move it around, but they've got to keep it there. Well, it's been amazing, but what we've seen in recent years is that despite some pretty shocking developments like 1997, the Dow dropping 550 points in a single day, or over the past year, the NASDAQ dropping 60%, we've seen investors hanging in. It's been really amazing. Up until last month, in fact, there were net inflows into stock mutual funds. People were not pulling their money out of mutual funds. Last month, they began to pull their money out, but not very much. And I recently interviewed an official at Morningstar, which is a research firm that follows mutual funds, and she came to the same conclusion that I did, which is that the behavior of investors, despite this bear market, and it is a bear market, it's been down 20%, that's the official designation of a bear market, has been exceptional. The fact is they have stayed in, which is what they should be doing. Doesn't mean you shouldn't review your portfolio. A lot of people got stuck with tons of high-tech stocks. They were overweighted. You need to review your portfolio. But in general, people have stayed in the market. I think I need my water, sorry. The second assumptions, thank you. The second set of assumptions have to do with the economy itself. And when we wrote our book, our assumption was that the economy would grow at about 2.5% a year, which is the average since World War II. And one of the things that we find in the stock market is that the market as a whole companies tend to increase their profits at the same rate as the economy as a whole. And in fact, that is directly linked, that profit growth is directly linked to their stock prices. So what goes on in the economy is very, very important for stocks. Well, we started to write our book about 5 years ago, and actually the event that really got us going on the book was December 5th, 1996, a little less than 5 years ago, when we were at the annual dinner of the American Enterprise Institute, and the speaker was Alan Greenspan. And his topic was a history of the Federal Reserve, 1913 to 1996. So if you think that my talk today is a little dry, you should have been there that night. I'm sure some of you were there that night. So we were all beginning to nod off, and he's coming to the end of the speech, and he mentions that he is worried about what he called irrational exuberance in the stock market. You probably remember this. Next day, the Dow dropped 200 points in the morning. That was a lot in those days. And people began to get worried. Well, Kevin and I got together that morning. We said, you know, if Alan Greenspan thinks that the only reason that stocks have been rising since during the 1990s, even during the 1980s, is because people are irrational, that is to say they're crazy, then we better get to work on a theory of why, of what's really been going on, because it's not that they're crazy. I remember when I began my column in the Washington Post, it was July 1993. The Dow was at 3,500, and there were people saying then that stocks were overvalued. By December 96, the market had risen to 6,400, 3,500 to 6,400 in about 3 years, 3.5 years. And Alan Greenspan was saying then that he was worried about irrational exuberance. Well, today, 4.5 years later, we see the Dow at 10,900, considerably higher than when Alan Greenspan was talking about irrational exuberance. Anyway, we wrote the book then. At that time, we started to work on the book then. At that time, the expectation for economic growth was actually in the low 2%. So let's say 2.5. That was our assumption. Well, now, many economists, in fact, the Congressional Budget Office is saying that 10 years out, as far as we can project 10 years out, the average growth ought to be about 3%. So actually things have gotten a little bit better. But we don't necessarily have to buy what the CBO says. Let me do this. I want to talk to you about the economy and really the underpinnings to the stock market in the time that I have left. And I'd like to do it this way. I'd like to talk very briefly about the state of the economy today. Second, about why it has slowed down. Third, why it was so good before that. And fourth, what we can do to get it to where it was. And I want to do that in probably not very much time, and I want to leave some time for questions. So let me do it really quickly. Well, I don't have to spend much time on what's going on now in the economy. The economy has slowed. The U.S. economy has been growing over the last 8 years by a remarkable 4%. Remember I said 2.5% was the average. 4%. Quite amazing. In fact, the worst year we had in the last 8 was 2.7%. Very powerful and very consistent growth in the economy. Then second quarter of last year started to slow down. Went from 5% to 2% in the third quarter to 1% in the fourth quarter. Then all of a sudden, a couple days ago, we get the first quarter results, and instead of being negative, as some people expected, or maybe just slightly positive, turns out to be 2% growth, which is, while not impressive, a sign the economy may in fact have bottomed. I'm not sure that's true. Unemployment remains high. Purchasing managers' reports are not very good. Industrial production has dropped. Consumer confidence has gone through the floor. I think this is a classic slowdown. Don't think it's a recession, never have, but it certainly is a significant slowdown. When you slow down from growth of 4 or 5% down to 1 or 2%, even if it's not officially a recession, which is 2 quarters of negative growth, they call it negative growth. It's like it's an oxymoron, you know, like jumbo shrimp. Negative growth, just a decline for 2 quarters. It feels like a recession, even if it's not. And certainly the high-tech sector has really been hit. Cisco Systems, the giant internet infrastructure provider, was increasing its revenues at a 70% pace as recently as November. By February, its revenues were down compared to the year before. A huge change. The authors of a recent study, they're looking at San Francisco Bay, estimate that 80% of the remaining .com companies in the San Francisco Bay Area will collapse in the next year. So the economy has slowed. It's not particularly very good. But before I talk about why it slowed, let me just talk briefly about why it has been so good. You know, it was Ronald Reagan. Ronald Reagan said a lot of really interesting things. He was very good about cutting to the chase, being very direct. Ronald Reagan said about economists. Economists are people who see something work in practice and wonder if it would work in theory. So, probably run into people like that every day. So what's been working in practice has been the U.S. economy, working incredibly well. The U.S. is now in the 10th year, we're about to finish the 10th year of a prosperity, that is to say a period of without a recession. First time this has ever happened in American history. First time we've ever gone more than 9 years with growth, only growth. We are now in the 19th year of a prosperity, a period of prosperity with only one recession, a very shallow recession in 1990 and 91. No economy in the world, I think it's safe to say, has ever seen such a boom in output and the accumulation of wealth in so short a period, 2 decades. Since World War II, there have been 9 recessions in 56 years, but in the past 19 years, there's only been 1 recession. Something is going on. Something profound is really happening in the U.S. economy. I think it's important to understand what it is. Why haven't we had the typical business cycle? Well, here's how the business cycle works. You have demand for goods, prosperity. People want to buy things, goods and services. And usually, this demand bumps up against some constraints of supply. Businesses can't produce things fast enough. There are bottlenecks. Prices rise. You get inflation. The Fed, whose job since 1913, I listened to the speech that Alan Greenspan gave, the Fed's job is to maintain the value of the dollar. So the Fed comes in, raises interest rates, knocks down inflation. We generally go into a slowdown or a recession. Interest rates fall, the economy recovers, cycle begins. Again, that's a typical cycle. But we haven't really had that in 20 years. And it's important to understand why. I think the reason is because of what I call a liberation of supply. So that what's happened in recent years is that as we've had prosperity, we've had increased demand, but we've also had increased supply. So we haven't gotten the kind of inflation that all the economists said we were going to get. They said, oh, you can't have unemployment below 6% without getting inflation. You can't have growth above 2 or 3% without getting inflation. Well, we've had that. We've had unemployment below 4% without any kind of significant inflation. Why? Why do we have more supply? Let me just tick off 4 reasons why we have more supply. Number 1, the spread of free trade. When bottlenecks occur in this country, we've got goods from other countries to fill in the gaps. Also, free trade and immigration. Immigration has been enormously important in this cycle. We have not had the labor shortages that we've had in the past, and it's because we've had more of an open door to immigration. We've also had a free flow of capital across borders, a kind of a free trade in capital. Second, lower tax rates. You know, before Ronald Reagan became president, the top rate on income was 70%. And that will deter investment, I guarantee you. And it did deter investment. It's been cut, still too high in my opinion, but it's certainly we are in a much better position to encourage investment, and we have more investment, more capital, again, more supply. Third, better monetary policy. Alan Greenspan is not God, as we've learned. Some of us already knew that, but he certainly has learned from his predecessors, learned from Paul Volcker, who did a wonderful job, I think, even though it was tough getting through the early 80s, and Volcker learned from his predecessors. In general, the Fed has learned from the past and done a good job, and I think that Greenspan's successor will learn from him. So we've had better monetary policy. We've been able to hold down interest rates. Again, cost of capital is lower. We get more supply. more goods and services. And fourth, the high-tech revolution, the advent of inexpensive, powerful network computers that give us more as a result of these computers. We have more output for the same inputs. That is to say, a rise in productivity. It's been tremendously important in this growth period, and it's going to continue, I think. We've had about twice the productivity that we had in the 70s and 80s, and it's the key to the growth that we've been having. So, this time, we didn't get the normal business cycle. Demand rose, but supply also rose, so we didn't have inflation. We have CPI price increases now, 2%, 1.5% at a time when the economy was growing very swiftly. Okay, so why did we slow down? We did slow down, there's no doubt about that. Why has this happy picture changed? 4 reasons. First, the Fed rate hikes. I think the Fed made a mistake. And frequently, my colleague at American Enterprise Institute, Alan Meltzer, who is a historian of the Fed, points out that many recessions have been caused by a Fed mistake. Fed began to raise interest rates in the middle of 1999 with, in my opinion, very little sign of inflation. And then, when the economy began to slow, it took a long time, it took until January, for them to get on the ball again and begin to cut interest rates. Second, the tripling of oil prices. 8 out of the 9 post-war recessions have been preceded by a sharp rise in the price of oil. And it's not just the price of oil that's caused the recession, it's the price of oil plus a Fed rate hike. And that's basically what happened this time. It's a deadly combination, and we got it again. Third, the drag of high taxes and a gigantic surplus. Federal tax revenues as a percentage of GDP last year were the highest in history since World War II, only twice, 1944 and 1945, has that percentage been higher, percentage of taxes versus output. So no wonder the economy is slowing. Taxes are producing a drag, a predictable drag. Also, as wonderful as the surplus is in many ways, it's really a reflection of high revenues flowing into Washington, where that money really should be kept in the private economy. It would be better for the economy. Cash that could be used for consumption or investment is instead flowing here, where it's being used to retire bonds or used to finance more government spending. We've had 3 years of very high increases in government spending. And the fourth reason for the slowdown has been the end of what I call the high-tech enterprise zone. High technology has kind of outstripped the ability of government to keep up with it. And I use the term enterprise zone, or it did outstrip it. I use the term enterprise zone, which is a term that Jack Kemp coined for an area within an inner city in which there would be no taxes or very low taxes to encourage economic growth. Well, we kind of had that in the Internet. Internet's been largely untaxed and largely unregulated. Well, that has not been true for the last year. Suddenly the government caught up with the Internet, and I think the seminal event was the antitrust suit against Microsoft. Whatever you think about Microsoft, I think in a symbolic and in a substantive way, the effort to break up Microsoft was damaging not only to that company, but I think to all of high tech. It was not a coincidence that NASDAQ started to fall almost in the instant that the government decided that it was going to go for a breakup of Microsoft. I just want to touch on a couple of these things. I know I don't have very much time, but as far as the end of the high-tech enterprise zone is concerned, two areas that concern me. Well, let me just talk about one at this time, and that is the lack of broadband services, the lack of fast internet connections around the country. Only 5 million American families now have fast internet connections. This has really held up the growth, the potential of the internet. And why? Well, I think it's because the promise of the Telecommunications Act of '96, which is a great piece of legislation, has not been fulfilled. We have not managed to deregulate. The Bell companies still control the last mile. Deregulation is not over. And until it is, we're not going to have a liberation of supply as far as broadband is concerned, and I think that it's absolutely necessary. So, what can be done and what is being done? Well, on two fronts, something is happening. The Fed is cutting rates, as you all know. Short-term rates have gone from 6.5%, unconscionably high. In real terms, you take out inflation, we had rates of like 5%. Short-term rates, ridiculous. It's going to slow down growth if you have rates that high. They come down 2 percentage points. I think that the Fed will cut rates by another percentage point. Typical Fed loosening is 300 basis points or 3 percentage points. Fed has a meeting in mid-May. Almost certainly will cut rates by half a point and probably another half a point after that. And that's good. We're going to start to see the effects flow through. Second, tax cuts to reduce that tax drag that I talked about before. It's, as you saw in the papers today, there's a deal that pretty much has been done. We're going to have about $1.35 trillion in tax cuts over the next 10 years. Not enough. Again, in my opinion, you've got a $5 trillion surplus, but still, we'll get things going. Third, energy policy. We really, in the last 10 years, this country has essentially has not had an energy policy, and we've suffered greatly from a lack of supply. And as the economy grew, demand began to bump up against supply. Those old bottlenecks that I talked about. We're seeing it in California in a very dramatic way, but we're going to see it in other parts of the country too. We have got to increase supply. And it is encouraging that the President's been talking about that. We need to balance environmental concerns against economic concerns. And in recent years, there has been an imbalance on the environmental side. Not that I don't believe in environmentalism, I'm a big fan. But I think the President was right to say that Kyoto, which is to me a symbol of almost insanity as far as going way over on the wrong side when the science is not there, the Kyoto Agreement, based on a study by the Energy Department, said that we would reduce GDP by 4 percentage points a year, which means you go from 3% growth into a recession. $1,000 to $2,000 per individual in America would be the cost of Kyoto. It's way too high based on unsound science. So that's good, energy policy. And finally, regulatory policy. We need to go ahead with that broadband rollout. We need to change antitrust policy because in an internet age, antitrust is not the same as it is in a steel age. And we need sensible policies in such areas as privacy. If we do these things, we will get back to 4% growth, which would be phenomenal. Think about this. If the economy grows at 4% a year, within the span of a lifetime, the average family will increase its standard of living by a factor of 16. It's almost inconceivable. 16. Instead of owning 2 cars, you could own 32. Instead of having a house of 2,000 square feet, you could have a 32,000 square foot house. It's hard for us to understand that, but that's what 4% growth means. Even 3% growth would mean, gosh, you could have 16 cars instead of 2. Okay, that's what growth means, and that's why it's so important. Just let me end with this thought. You know, when our book was published in September of 1999, it was very widely reviewed, highly controversial book. It does have a very inflammatory title, you know, Dow 36,000. We were thinking about calling it A Treatise on the Declining Equity Risk Premium, but we thought that wouldn't sell too many books. So we call it Dow 36,000. Anyway, it was reviewed in the Wall Street Journal by Burton Malkiel. He's a great economist from Princeton, and we were flattered, we were honored to have it reviewed by him, but he called the book dangerous. So I thought, well, why is this book dangerous? You know, actually, you heard me. My advice for the 6 years I wrote my column in the Washington Post is kind of boring. It's, you know, buy good companies, hold diversified portfolios for the long term, you know, don't chase fads, that sort of thing. Not hardly dangerous. Well, he thought, well, people would see the title, they wouldn't read the book, and they would jump into the stock market unprepared, and they would get hurt and so forth. Well, you know, that may be true, and if that is true, I feel bad about it, but certainly the book itself is quite moderate in its views. What is dangerous really is not to be in the stock market. And these days, I'm fighting a battle over and over again in places like CNBC against bears who are now in their heyday, like stopped clocks. They're right twice a day. This is one of those times. The fact is that for most Americans, investing in the stock market is not just the best, it is the only avenue for accumulating the kind of wealth that will provide a comfortable retirement. It is a way to participate in the economy, and it's about the only way you can do it. If you're an entrepreneur, it's something else. But for the average person, that's about it. So we don't want to scare people out of the stock market, quite the contrary. So I don't think the message in the book, or the message that I give you today, is dangerous, quite the contrary. It's prudent, and if I'm right about being in a period, kind of a one-time period of revaluation of stocks from below 1,000 in 1982, 777, the Dow was at in 1982, to about 11,000 today, to 36,000 fairly shortly, then it is urgent, in fact, to be in the stock market and have the kind of faith that I believe is necessary and prudent in the U.S. economy. Thank you all for listening. So I was told earlier that we started a little bit late, so I'm now beyond 2 o'clock, but we do have time for questions if you have some questions. 2 questions. Okay, great. Yes.
I'm interested that you didn't comment about the national debt.
Right.
I'm just curious how you view debt in the overall view of the future of the U.S. economy.
The question is debt. How do I view debt as far as the future of the economy is concerned? I'm not actually that concerned about debt. I did a piece in the Weekly Standard about a month ago, which they headlined. I didn't do this. The joy of debt. And I'm not happy about debt, but I'm also not all that upset about it. The debt that we have built up in this country, that's owed to individuals, as distinguished between debt that's owed from one part of the government to the other, is about 1/3 of gross domestic product. That's not a big number compared to other countries in the world. Japan, it's over 100%. Most countries, it's over 50%. It's a manageable level. Now, I don't want to see it go any higher. And in fact, I think that leaving the debt where it is, right now we owe about $3 trillion to individuals. If you just leave it there and let the economy grow, and the economy will roughly about double in a little over 10 years, then from being 30% of the economy, it'll be about 15%. So it'll even be smaller. And I don't mind even paying off half the debt. The problem I have is that we're going to run into a situation in 5 years, and Alan Greenspan talked about this when he was up here testifying, where we will run out of debt to retire. In 2005, there will not even be enough debt there won't be enough bonds to cash in. The Congressional Budget Office, in its latest report, January 31st report, coined a new term. Never had coined this term before in history. And the term is uncommitted funds. And what uncommitted funds are is revenues that flow to the Treasury that cannot be used to retire bonds because there are no bonds to retire. That's a condition that we will reach, if these projections are right, and we don't know whether they are or not, but I think they're pretty reasonable. We will reach that position by the year 2006, which is only 5 years from now. And I think that's pretty scary, because what's going to happen to that money, to those revenues? Well, what Alan Greenspan is worried about is that those revenues will be used to purchase private securities, to purchase bonds and stocks, mainly to be held by the Social Security Trust Fund. That is a very frightening development when the rest of the world's moving in the opposite direction. So it's kind of a long answer, but in general, I think we are well on our way to taking care of the debt problem. In fact, we're beyond well on our way. I think at this point, we ought to leave more money in the hands of individual Americans, because that's better for the economy. Yeah. Yes, Congressman Lundgren.
You talked about the tremendous faith you have in the stock market and in the market in general. And you mentioned the energy crisis in California, for instance. In my view, we not only have an energy crisis, we have an impending water crisis coming down the line, we have an impending infrastructure crisis. Is it because the market does not somehow accurately reflect those kinds of fundamental requirements that these things may not be taken care of? Or is it because of certain government policies we have interfered with the market system and the market clues that it would otherwise give us that we are not dealing with? Because my concern is this: everything else could be going fine, and we could understand the seriousness of the high-tech economy and how that does open up the vistas for us. But if we fail to take into consideration some of the fundamentals, like if we don't have adequate water in California, not only is it a serious problem for people living, it's a serious problem for the high-tech industry. The same thing with infrastructure and energy.
Right. This is a very important question, and you know, my answer, and you're not going to be surprised to hear this, is that we've interfered way too much with the market. And one of the things you said, the market provides clues. One of the things that markets do is that they send signals through prices. When prices rise, it's an indication that you need more supply. And usually what happens is suppliers rush in because the price is higher and provide that supply, then the supply comes down. So market prices are very important signals. The problem is that when we allow government and politics to get involved, things happen like price lids. So we don't get the signals. We don't know that demand is increasing because there are no market prices. So other suppliers can't rush in. So we have to let these prices go up and down. Now the problem, of course, is that when we're talking about vital services like water and electricity, you can't have people, not allowed to have water. They can't afford water or they can't afford electricity. So I think the role of government here is to provide subsidies for people who can't afford them, but to stay out of the market for water, stay out of the market for electricity. And the problem in California, as you know as well as I do, is that a very imperfect, to say the least, so-called deregulation was started a few years ago, in which prices were capped. The suppliers were basically not allowed to supply, and nobody was allowed to enter into long-term supply contracts. So you had this kind of completely screwed up market, and as demand rose, you got a crisis. Just one example of how it can work. In Santa Barbara a few years ago, there was a water crisis all over California a few years ago, and in Santa Barbara, instead of the government telling everybody, well, you can only water your lawn on Thursday or Tuesday or whatever it is, which I think is, it's basically an abridgment of people's freedoms. Instead, they said, well, what we're going to do is we're going to let the price of water rise to the level that it ought to rise. So it rose about 40%, and people made their own decisions about when they were going to water their lawns. They didn't water the lawns as much, or they watered them at a different time of day when they had lower rates. So I think it's not easy. The problem is getting from a regulated system to a deregulated system in any institution is really hard to do. So we're doing it now in utilities, and there's been, I hope there won't be a big setback because Pennsylvania is doing it well. There are other states that are doing it well. And we're trying to do it in telecommunications in the same way. Again, it's not easy to do, but I think that's got to be the answer. The other is not the answer. Anyway, thank you all very much, and congratulations.
Jim almost walked off with my schedule, and I couldn't tell you where we're going next. We are at 2:30 to be at 1539 Longworth House Office Building for what promises to be a great panel of journalists. So see you 1539 Longworth at 2:30. Thanks very much. And thanks, Jim Glassman.